whilst we're waiting for the new administration to take office, what are your base case thoughts then, Manish? I know you've been doing a lot of analysis that compares Trumponomics and what we know about it so far to Reaganomics. There are big differences in your mind.
I do, and I like to say that Trump policies at the moment are mostly like basket of unknowables, in the sense we get tweets and we get things that he has mentioned so far, but when he becomes president on 20th and then he implements policies, that's when you will really see the big change, and the time it takes. To me, a lot of what he has said is going to be backloaded, in the sense that you will feel a major impact of that in second half of 2017 and more 2018 rather than early. Which is why if you see the market correction, I believe that market could correct in first quarter of Jan. Now coming back to his policies, yes, if you look at 2 points he mentions about, of course he talks about making America great again. I think that he can make America better, but great, I think, is a very strong word, given that we live in a multipolar world, and US has lost a lot of its hegemony and strength, and it is not a matter of last 4 years, it has been going over last 10 years. So if you look at compared to the Reaganomics days, when President Reagan, he increased the debt to GDP from 30 to 50%, during his time.
That number looks very different now.
Very different now. We are at 105. If you do the same policy, it goes to 135. Which is probably the highest debt to GDP in the world, even higher than Italy. But even bigger factor, which I think is more significant, is the demographics. At that time, the working age population in US was growing at 2%. Now it's growing at 0.5, 0.4%. Now, if President Trump goes on to implement his policies about removing unauthorized immigrants, workers from the economy, that'll again be a hit too. So you will have hit on consumption. So I don't think he's going to follow up on his policies. There was a lot of rhetoric as it comes during election time. So his intentions are very strong, in the sense that it'll help dollar gain strength. It'll keep US equities as, on a relative basis, a better market to be in compared to the rest of the world.
Okay.
But I think a lot of what he has said will not be delivered, because it cannot be delivered.
We see a little bit of weakness coming into the dollar in today's session. Certainly, we're down by nearly 0.5% on the dollar index, down 0.4% on the Bloomberg dollar index. But strong dollar has certainly been one of the themes towards the end of 2016, hasn't it? I've got this chart here, very patriotic number for this chart, BTV 1776, of course, important year in US history. Trump bump. Bloomberg dollar index gains 23 of 36 trading days. You suggest then that you think there will be some further dollar strength to come, but is the market overdoing its king dollar bets?
Sure. So I would say that dollar strength is definitely a story, because if you look on relative interest rate basis, we are talking about, US is much ahead in the cycle. I mean, last year, when in December 2015, when Fed said that they're going to raise rates by 4 times in 2016. I found it incredible, and I wrote in my piece that they'll be lucky to get 2 rate hikes. They eventually got one, as we know. Now, I think that what Fed has said, or the dot plot is indicating 3 rate hikes, they might get 3, or maybe they will get 4. It'll totally depend on how things are going on, if Trump was to implement some of his policies he's talking about. So I do think that is going to help the dollar strength. Now, if you look at it, we have had like 3 big dollar cycles, since it became a floating rate in 1970s. First one was again during the Reagan administration, which it went from, and that obviously, as we know, brought about the Plaza Accord, where Japanese yen was forced to strengthen against the will of the economy, basically Japanese economy, and that completely killed the Japanese economy at that time. And the second was in the latter part of Clinton era, when you had the dot-com, the technology revolution that happened in US. Now this third one, we are seeing another big rally. What is going to stop this rally? So the only thing which I think stops this dollar rally is if dollar becomes too strong, and then Fed is forced to raise rates very quickly, and that brings about a recession.
Okay, and we see the FTSE 100 at these record levels. Of course, if you looked at the FTSE 100 in euros or in dollars, it wouldn't look quite so impressive. In fact, in both those currencies, it's underwater for the year.
Yeah, that's true. And I think that my view is that we are heading towards triggering of Article 50, which has been a big thing. I do not see that you're going to see the market really surprised when it happens in Q1, because to me, the vote was a bigger shock, and we have been playing through it, and we have seen how the sentiment has carried on to be positive. Some people might say, okay, UK has not exited the EU, and that's okay, acceptable reason. But what I also see is that, if you look at the why did this happen? I mean, it was in response to, so UK asked EU a genuine question that they would like to control the free movement of people. It was coming from domestic concern, and EU said no. And therefore, the people voted to leave the EU. So it was not about, you suddenly decided one day, oh, I'm going to pack my bag and leave the EU. So it was in response to a domestic problem. So if you keep that in mind, that was not being driven by a trade barrier or some kind of other ulterior motive, then, economy should continue to be positive because you're still doing the same thing. Now, I have been part of some discussions with some business leaders and some political people as well. And what I gathered from the senior European leaders' side is that, the word is pragmatism. That EU and UK both have to understand that it is in their interest to find a solution which is pragmatic, which keeps things going. Because we talked about demographic problem in the US. Europe has a bigger demographic problem as well.
I suppose what that pragmatic outcome looks like, what pragmatism looks like from a European perspective, from a British perspective, might very much depend on who the leaders are in various parts of Europe come 2017.
Absolutely. So I think that you will not see a big discussion on trade deals post probably the German election. So I don't see a lot happening in terms of negotiation until the German election is over, which is August. So, and market cannot wait. You have seen with Trump election, everyone thought market is going to crash. They stayed out in cash and the market kept rallying. So if you think that this is going to continue over 6 months, 9 months, you're not going to be short the market. So people may be surprised that the market will carry on and it will continue to be positive because you see this happening more latter half of the year.
The UK, the FTSE 100, of course, has never really recently been much of a reflection of the UK economy, much more of a global barometer. In terms of the UK economy itself, is there a point in time, you talked about when this starts to really impact markets, is there a point in time when depending on how far out of the EU we end up, how hard the Brexit ends up being, is there a point in time when that comes home to roost and investors say, well, I'm not going to invest in those UK corporates because they don't have quite the export potential that they did before?
True. I mean, I think, well, so the nuances of the deal we don't know, but I think to me the bigger thing is going to be if UK is able to get a good deal with the US, and we are seeing sounds of that, and with the rest of the nation, that will assure the market in how things are. And ultimately it comes down to technicalities, whether who benefits from this, and if there's an all-out war in the sense, we're not going to do a deal, then of course UK is going to suffer. I mean, there's no doubt about it. But I see chances of that happening very, very low. Just
looking at the way that the Bloomberg Commodity Markets has indexed there on that graphic has bounced back. So it was weak 5 years ago. It was strong 5 years ago. Then we've had these years of weakness, and then once again returning because of a resurgent oil price, because of zinc also. Where do you see commodities heading into 2017, and what are the broad brush themes that will either boost that or keep it in check?
Sure. So if you look at commodities, they move in really long cycles. 10-year bullish cycle, 20-year bearish cycle. So we had bearish from 50 to 72, 70 to 82 was bullish, then 82 2002 bearish, 2002 2012 bullish. So if you look at the larger cycle, then we are still in a bearish trend. However, that doesn't mean it'll keep falling all the time because you get to an oversold level and people start buying it. So I'm not very bullish on commodities. I think that you're seeing a rally, which is because it's coming up from a far sold off position. With respect to oil, I see it's staying probably in $55, WTI staying in $55 to $60 range, clearly being supported by the OPEC and non-OPEC agreement for cuts. And so I would say that, and in terms of metals, I think we might see some more rally, but I'm not very bullish on metals.
And how does this tie in with your emerging markets view then, Manish?
So I would say that emerging market clearly plays more on dollar story because of obvious reasons we are talking about. So yes, some of the commodity exporting economies are going to get some boost based on energy prices and metals prices. But if you look at dollar strength story, and I believe the dollar is going to be a strong next year, then that is bearish for emerging market.
Bearish for emerging markets. And are you focusing on any in particular? Is it the trade spats that worry you into 2017 and focus there, or it's just all about dollar strength?
Sure. I mean, I don't like to call China emerging market, though it's categorized so, given that how powerful and big economy they are. I think the biggest story in emerging market is India. And we've heard about the demonetization story and how it could have an impact on GDP growth. And I think we could have some of these numbers coming in Q1 and Q2, because India is seen as a shining example in terms of GDP growth. But the effect of demonetization probably is going to be felt in Q1 and Q2 next year.
Yeah. Interesting to see how Modi seems to have changed the narrative around the reasons behind the demonetization. So talking previously about wanting to clamp down on corruption, and now changing the narrative to talk more about a cashless society and digital economy and all of that. I mean, what's your assessment of what he's doing with the economy and how necessary it was?
Sure. So I think that, does India have a corruption problem? Absolutely, and it needs to be solved. But you cannot impose a cashless society on people. It has to come also with an acceptance. So I see why he is trying to do that, and there is a need for it. But if you use patriotism and shame as a big cocktail, people support your policies. And you saw that what happened in Germany in 1940s, when people were shamed to support the troops on the borderline, they donated 74 million pieces of clothing, wool and everything, blankets and others. So I think people will support him. I don't think he is going to back down. People will support him because majority of the people, they think that corruption is a problem.
So he survives this because he asked the people to give him a certain number of months.
Yeah, I think he survives it. It is not going to be great for the economy. That will bring into picture what RBI does and whether it has an impact of Indian rupee, and given that emerging market do rely on dollar funding, then it could be bad for equity market, bad for GDP growth. But I think he will survive, and probably he'll double down because he's not going to back down, in the sense that because that will be completely loss of face that he got a policy wrong.
Where do you see the BOJ then heading into 2017?
So I think BOJ will continue to target the 0% yield on 10-year. I think that's the announced policy, and I think they're going to continue that. I mean, what we are not seeing, that we are not seeing a pickup in inflation. I mean, Kuroda's term is about to come to an end. And look what he said when he came in, that he is going to make it his aim to achieve this 2% target they talked about. We saw some acceleration, but it petered out. So my point is that unless you see the wage inflation, unless you see those numbers coming through, Bank of Japan just cannot back off and say that they're not going to target yield or zero yield on 10-year.
Does a weak yen and a resurgent commodities complex, does that help the BOJ in its cause?
So I would say two things helps BOJ. So if you look at, we have seen another round of fiscal stimulus in China, that helps Japan. If you're seeing that, if there's going to be a global acceleration of growth, that helps Japan. And there are two aspects. If you look at Nikkei as an equity index, I mean, that has a very strong correlation to dollar JPY. So if you see the dollar strengthening, then clearly repatriation of dollar earnings back to Japan is going to make the Japanese equities look better. But economy is a completely different story if you're mentioning in terms of nominal GDP growth. And I would like to point out that, we talk always about nominal GDP growth. If you look at the real GDP growth in Japan, exclude the inflation part, and look at real GDP per capita, that is not as bad. I mean, you have seen, even though people talk about lost decade, you see a 1% growth in real GDP per capita. To me, GDP per capita, real GDP per capita growth is far more important than the nominal GDP, nominal GDP is good for asset owners. We keep talking in terms of top line. And you could also see, if you compare US and Japan, if you look at the income inequality, in Japan is far lower. If you look at 0.1% of the wealth is being held by 0.1% population holds how much of the wealth of the nation, income. That ratio in US is 12% and 4% in Japan.
When we talked about the United States, we were drawing parallels, or you've been drawing some parallels and finding the differences between Reaganomics and what we know so far about Trumponomics. Of course, Reaganomics, in part, took the US into conflict with Japan economically, and the Plaza Accord we talked about a little bit earlier on during the programme. Where does the relationship between... are we going to see some conflict between the geopolitics of the US and Japan under Trump, or is Trump going to be more focused on what his relationship with China?
Yeah, so I think the US-China relation is going to be far more important, and the implications of that. Now, this is where the difference is very, very real compared to what happened in 1985. The reason US was able to force Japan to appreciate their currency because they had won militarily over Japan. They haven't won militarily over China. Rather, China is a resurgent economy which wants to, put itself as one another superpower. Now, the rise of China also has been helped by US, because the reason US embraced East Asia or Asia as a whole, because they were trying to win against the Russians. So it was a quid pro quo that we let you into WTO, you access our market, but there was also an implicit promise that when you become wealthy, we'll access your market. And China is not sticking to that side of the bargain. I mean, they have their own reasons for not doing it, because they see US as somebody who will come to destabilize them, and there could be many reasons for that. So to me, the US-China relation is going to be the defining moment as we go forward, not as much as Japan, because Japan will do what US tells them, and it's export-driven economy, and they're not looking for military expansion. But China is looking to establish itself at par with US whenever it is, but they are definitely on that path. So to me, that is a more important relation.